Welcome to Shenkman Education. My name is Martin Shenkman, and the topic of this quick video clip is a complicated tax topic, but if it could work for you, it could be really valuable. It's called a Wandry with a secondary sale. Wandry is a court case that permitted somebody to insulate from potential gift tax a transfer of a valuable asset to a trust. So let's say you're transferring an asset to a trust. I'll use a number, $20 million. You may sell it to the trust, but what if the IRS says it's worth $30 million, not $20 million? Now you have a very substantial 40% gift tax on the excess or the difference. So people use a Wandry clause named after a case called Wandry, W-A-N-D-R-Y, in which the taxpayer transferred an asset, can be by gift or sale, and said instead of transferring 50% of an LLC, limited liability company, I'm transferring $20 million worth of the LLC. So if the IRS comes in and says that 50% wasn't worth 20 million, but 40 million, okay, I only transferred 25%. Why? Because I didn't transfer a specified percentage. I transferred a specific dollar value. The problem then becomes when you use this, and that's fairly common technique used in high-end estate planning. And by the way, the IRS is non-acquiesced, so they don't accept it, and they will fight it on an audit, but there is some law to support it. But what happens with the excess? One of the problems, and sorry to be technical, there's a case called Powell and another called Moore, in which when the decedent in conjunction with others controlled the ability to make distributions from an entity or to liquidate the entity, the IRS argued it's all back in their estate, and they were victorious in those cases, and the results could be very costly. So what do you do to get rid of the full 50% if that's what you own and you want to, but you want to insulate yourself against a gift tax, and you don't want to have this residual Powell, and you don't want to have all the administrative complications of allocating between yourself and a trust if there's a later adjustment? Do a secondary sale. This is a suggestion. There's no law supporting it, just an idea, where on the same day that you make the gift or sale to the LLC, you sell any residual interest. So let's say sold $20 million and the IRS says it's 40, so I only got rid of 25%. As of the same date that I made the first transaction, I make a secondary sale agreement for gift tax value is finally determined. I sign a secondary purchase and sale agreement, have a note attached that would bring interest back to the date of the first transaction, and now I've removed all interest from myself, avoided the Powell moral issue, avoided the administrative complexities, and hopefully have still insulated myself using the Wandry mechanism from a gift tax. So that's a creative technique to think about. Thank you for joining me. Please keep in mind that all the information on Shenkman Education is for educational purposes only. Don't take any legal action without appropriate authority. I didn't mean that. Without appropriate legal guidance.